Employees are insiders. Frequently, they have relevant information, or at least better context and understanding about the company's activities and performance. And sometimes they use it to buy or sell the company's shares. It is known as insider trading, and is generally frowned upon. Investing is a game of making predictions about the future. If you want to earn more money, then you have to find a way to make better predictions. A way to make better predictions is by having better information. You may know that a company's vaccine candidate has stellar phase 3 clinical trial results, and once that information becomes public, its stock will surely zoom. So you may buy a bunch of shares before that happens, and make a lot of money when the share price goes up. People believe that insiders can make better bets about the future of the company, and make money in the stock market. They can do that because they have better information about the business, which may not be widely available. People worry that if a lot of that happens, then many will lose faith in the stock markets, which is a very bad outcome. To prevent that, there are myriad ways in which companies and the SEC tries to clamp down on insider trading. For example, some companies have blackout periods, when executives are prevented from trading, like a stipulation to not trade for 2 weeks prior to a quarterly earnings announcement. Also, there are SEC-approved schemes like the 10b5-1 plan, under which executives can create a plan for buying or selling the company's shares in advance, and then trade according to that plan. However, people are still unhappy because executives seem to outperform the market consistently. So, here's Bloomberg. Purchases made by U.S. executives outperformed the S&P 500 over the ensuing 12 months by an average of 5 percentage points. Between 2015 and 2020, according to a TipRanks analysis. This is not a trivial advantage, and it seems to persist over long periods of time. It is interesting to note that, on Wall Street, it's long been an open secret that insiders trade on what they know. There is a school of thought that considers insider trading to not be as problematic. In fact, some believe that it could be beneficial. Their basic argument is that insider trading helps improve market efficiency, because it is distributing information faster. For example, a company which made a vaccine with superb phase 3 clinical trial outcomes is more valuable. An insider buying its shares even before the phase 3 clinical trial results are public, is helping to move the share price up, and towards a more genuine value. Of course, fraud is genuinely problematic and punishable. Here's a recent example, as reported by Bloomberg. A former Goldman Sachs Group compliance analyst, whose job was to help the bank prevent insider trading, was himself charged with insider trading by the Securities and Exchange Commission. The SEC sued José Luis Casero Sanchez on Wednesday, claiming he used his position in the bank's Warsaw office to access a control room, which stored confidential information on all pending and potential transactions, in which the investment bank was involved and advising clients. He made at least $471,700 in illegal trading profits, the regulator said. He abused his position of trust by trading on at least 45 events involving the investment bank's clients, based on the investment bank's material non-public information. This is clearly problematic because he stole information from his employer to make those profitable trades. So that's it for this video. Please give a like if you enjoyed it, and consider subscribing as it helps out the channel a lot. Thank you, and I'll see you in the next one.